back to Business Today Television, and on our coverage of fourth quarter earnings, we present a stunning set of numbers from tyre maker CEAT Ltd, where fourth quarter sales rose 14% to 3,421 crore rupees. Net profit also surged, but was hit by a couple of factors, but the stock has done a fabulous job in the markets, now up a whopping 10% when it comes to the price of about 3,330 for the moment. Apart from that, net sales also rose 3.7% quarter on quarter due to higher volume growth in the OEM and the replacement market. We've seen EBITDA up 100 basis points quarter on quarter to 11.3%, and of course realizations improved both quarter and quarter, year on year. Gross margin is up 60% 60 basis points Q and Q due to flat raw material costs and of course the price rises that CEAT took. And the man of the hour, the CFO, Mr. Kumar Subbiah at CEAT Ltd, joins us to discuss the fantastic set of numbers and the way forward. Namaste and a very warm welcome to you, Mr. Subbiah. How do you look at the top 2 or 3 points as far as the fourth quarter gone by is concerned? What were the highlights of these numbers?
I think a very satisfying quarter, particularly on top line. In the beginning of the year, we embarked a journey in terms of growing our top line in double digits. Okay, by end of the year, we could accomplish it. On a full year basis, we grew by about 10.8% year on year. And in quarter four, our growth was higher. We grew by about 14.6%. So what is gratifying here is that, it was a combination of both price growth and volume growth. Okay, in quarter four, 70% of the growth came from through volumes and 30% came through price and mix. So I think growth of 3,400 crores revenue in quarter four and crossing 13,000 crores revenue on a full year basis. These are all very important milestones because they're the highest that we have achieved so far.
Yes.
And key aspect of quarter four was that there was some margin recovery in quarter four versus quarter three. Okay, so our operating margins grew by on a standalone basis about 120 basis points and on a consolidated basis about 100 odd points. So therefore, at least to that extent, after a few quarters where our margins shrunk on quarter, we could see some recovery in margin. That was something which was satisfying. Overall, on a growth basis, I think replacement and OEM business grew strongly in quarter four. Exports was flat in quarter four. On a full year basis, right from the beginning, replacement segment grew in double digits. Okay, and OEM recovered in the second half of the year. And mid-single digits is where the international business grew. So overall, a rounded performance, I would say, in terms of all segments growing, most of the categories growing year on year. Satisfying performance.
Okay. I was coming to your EBITDA margin, which has indeed risen 100 basis points to 11.3% sequentially quarter on quarter. But Mr. Subbiah, still way below the 13.1% that you reported in the fourth quarter last year. In fact, last year's operating margins on a quarterly basis were phenomenal. Any chances where you can see the trajectory of first quarter, second quarter, third quarter margins in the forthcoming year improving above 11.3%?
No, you see, look, we are more at the lower end of the range at this point in time with respect to our own margin aspirations. So if you really look at it year on year, and the gross margin shrunk by about 4.5% in quarter four of current year versus quarter four of last year. We managed to mitigate about 2% through cost efficiencies, scale related benefits. In terms of internal benchmark, we would like our gross margins, which is nothing but selling price minus raw material cost, to be in the range of 40 to 41%. So we are at least 2.5-3% lower than our internal thresholds. So when raw material prices move up marginally, okay, it can always be mitigated. But during the year, we witnessed some, unprecedented increase in commodity prices, particularly natural rubber reached 15-year high in the local markets. Okay, and while many other commodity prices corrected the global markets, but rubber-related materials, particularly natural rubber, some other petrochemical derivatives, held on. Though quarter four was stable, but it didn't correct to the extent the other commodity prices corrected. So I think we'll continue to take some selective price increases within the parameter of elasticity of demand, and if we are able to see some downward trend commodity prices, a combination of both, I hope we get back to the mid range or higher end of the range, which is about 12% plus or minus 2%, or 12.5% plus or minus 2%. That's the kind of a range that we generally operate with. We would like to move to the higher end of the range without giving any guidance that we will achieve it, but that is our aspiration.
Fair point. Mr. Subbiah, you are a past master at dealing with global headwinds and trade winds. You've been for 2 decades working with Hindustan Unilever and Unilever globally. Tell us, how was the international business at CEAT against the backdrop of this massive tariff war that's been unleashed by the United States? Auto sector was particularly worst hit. How have your exports businesses shaped up?
Okay, on a full year basis, exports grew by about 8.6% for us. Today, we call it as international business, okay, which is about 20% of our revenue, and we would like it to become 25% in a 2-year time frame, including the current year. That is a internal plan we are working with. So, based on our internal plan to reach that level, we did launch many new categories of tires in the international market. In the last 12 to 18 months, we launched our truck and bus radial tires in the US market, passenger car radial tires in the US market, and we are also expanding our farm radial business, which is 100% exports, okay, which is more profitable business, where we have a dedicated factory at Ambernath to produce tires. So we are preparing ourselves to reach that kind of number, okay.
Yes.
And in addition to that, I think you are aware that in the previous quarter, we also made an announcement to acquire Camso, which is a Michelin's group company, and we are acquiring that business. A particular category called as compact construction, and the brand Camso will also come to us in due course, and that is entirely for international business. Okay, so your question on the tariff of US. See, at this point in time, our exposure to US is under 5% of our revenue. Okay, and so therefore, any movement in tariff either way, okay, particularly if the tariff goes up, if it leads to some contraction of demand or alternate source of supply for US, or impact on margins and things like that, overall impact on CEAT would be lower. However, just to give you a context, uh, the tariff applicable on India on relative terms is more favorable than the tariff that the US is planning to impose on other sources for tires to get into US markets. So Southeast Asia is an important export hub for the US. Similarly, China. These are the two specific clusters or geographies from where the tires get exported into US. Largely, also it could also be because of the fact that one of the main raw materials, which is natural rubber, is produced in this part of the world, and but the tariff that was announced for Southeast Asian countries, most of the countries are 40% plus, 44. In fact, for Vietnam it is 48. Even for Cambodia it was 44%. Originally, US started with 36%.
Right, sir.
Yeah, but India was 26%. So relative terms, I don't think we have a disadvantage over other players. Maybe we have an advantage. That's what I feel.
Yes. It's actually a choice between bad and worse. We may be badly hit, but there are others who've been worse off. Let's come back to the domestic market. You announced a capacity expansion cost of about 240 crores, which was funded internally through accruals. Now, what is the capacity expansion that's planned for FY 26-27, which is ongoing, and when does that capacity come on stream, especially at Nagpur?
Okay, see, look, we are a capital intensive industry. So therefore, if we want to grow, we have to keep adding capacities. In the year that went by, we incurred a capex of close to about 950 crores. And 75% of that was for the purpose of expanding our capacities. Our plan for FY26, that is FY25-26, our capex is going to be in the order of 900 to 1,000 crores. Broadly, we are planning to last September, we commissioned a truck and bus radial tire plant at Chennai to produce tires to the extent of about 1,000 tires by end of March and 1,500 tires per day during the course of the year. We would like it to take it to 2,000 tires. So there's a capex planned for that. And Chennai factory also produces 20,000, has a capacity of about 20,000 tires of passenger car radial tires per day. Okay, which we would like to take it to about 26,000 tires by end of the current financial year. So there's a capex there. We also produce motorcycle steel radial there, which is a small amount. And last is our specialty tires at Ambernath, okay, which is predominantly for or entirely for exports. So these are the places where we would be spending large amount of capex. Some amount of project related capex will also happen at Nagpur, where we are created some framework to increase our two-wheeler tire capacity. So these are the areas where we would be spending capex, and our estimate is about 900 to 1,000 crores in FY 25-26.
Okay, let's look at the debt profile of CEAT Limited. About 1,630 crores is outstanding debt. It rose by about 95 crores because of working capital requirements, as also did interest costs. How do you see the debt profile over the next 4 quarters? Are you comfortable with debt to equity at the moment, or are there any chances that you'll reduce this 1,630 crore debt pile?
Okay, now see, I think if you add short term, we are about 1,920. That is a total debt as of 31st March. So in the year that went by, the overall debt went up by a little over 300 crores on a full year basis. In the quarter 4, the debt went up by close to about 90 crores or so. Okay, and in the last 5-6 years, we have invested more than 5,000 crores of capex in expanding various categories, the capacities of various categories, and we have been very responsible in terms of managing our debt. 5-6 years back, our debt was about 1,100 crores. Today, we are about 1,900 crores level. Most of the capex that we incurred, we could manage it through internal accruals. Now, at 1,920 crores of debt, debt equity is about 0.42, 0.43 in that level range, and debt EBITDA is about 1.3. So we are not fully highly leveraged. The leverage is still low. Okay, and we are very comfortable with the current level of leverage ratios. In fact, internally we are okay to go to debt EBITDA of 2, and our threshold in terms of peak is 3, while our financial covenants are at a higher level. So therefore, we are okay because we have to invest in capacities. We have to get that growth. Scale does play a role in terms of distributing the fixed costs across larger volumes. But now, your second question: do you see a debt going into the current financial year? See, look, in addition to capex that I just now mentioned, about 900 to 1,000 crores, we also have to fund the acquisition of Camso. The total consideration is about 225 million. We hope to, taking over that part of the business effective July. Okay, and we may, at an overall level, not necessarily to fund that at an overall level, because cash is fungible. Okay, and our debt level will go up, but we don't expect the debt leverage ratios to cross our internal thresholds. Maybe a peak of about 2.4, 2.5 could be the debt EBITDA point of view, but another 1,000 crores of debt increase progressively is possible if we take into consideration our total capex and also our investment required to for the purpose of CAMP. So that's the way we see.
Right. Let's look at the client profile, Mr. Subbiah. The 3.7% Q on Q increase in revenue came because of higher OEM demand. This is against the backdrop of a lot of well, not just say negativity, but lot of how should I say uh, the Indian automobile industry not being in top shape. What are your clients telling you in terms of their longer to medium term requirements of quality tires? What is the general crux of the conversation against this, import thing that we are seeing from China, the kind of problems that global auto industry is facing in Europe? What are your top clients telling you?
Okay, see, OEM business grew very strongly during the year. Okay, and strong double digits in quarter four in excess of 20% was our growth. Okay, so from our point of view, OEM, there are two things. One, sometimes OEM overall may grow in small single digits. That's what we are reading in papers in terms of outlook for OEM growth. Okay, we expect our OEM growth to be strong double digits coming into the year because our growth is strongly linked to the share of business that we get from OEMs, either for an existing models or mostly on new models. Whenever they come out with the new models, okay, and our share of business uh, has been very good. So therefore, that will take us to deliver some good growth in OEM business. See, having said that, OEMs is not a very profitable business. While it gives us a product reassurance, helps in terms of where the tires are replaced. Coming to your question on global auto and also the fear of competition from China, it it may be a little less relevant for India because I don't know whether we are going to compete with China with respect to auto sector unless EV segment where if superior
Yes.
vehicles come into India at a lower tariff, which even in case India decides to reduce the tariff rate, for example, for US at a lower rate. I think people who are planning to invest in India can bring vehicles of certain numbers at a concessional rate of duty, which is about 15%, I think, against the 70%. Could be, but from tire or auto ancillaries point of view, it may not be a big disadvantage. On a total PCR, passenger car market, under 5% is EV vehicle today, if at all EV vehicles are going to come. So it's not going to alter the situation.
Yes.
It's possible it may have some impact on Indian EV manufacturers who have some growth plans. Within that, it could. But EV as a sector, we expect it to grow on a small base. In two wheelers, growing strongly. In passenger, I think from under 5%, it's likely that in next to 5 to 6 years, it may reach in the range of 25 to 30%. So it's a strong growth area. So I don't see a big threat, but global recession may impact auto demand outside India. Any exports, particularly two-wheeler, India is a large exporter. Okay, in other vehicles, it may have some
Okay.
collateral damage, but not very big impact.
Okay. My final question to Mr. Subbiah: what is the state of Chinese imports of second-hand and first-hand tires in India? Is the problem sort of under control? Are you again looking at the government to somehow protect domestic industry? What's the status there?
No, Indian tire industry always is asking for a level playing field. Okay, I don't think there is any special concession. Indian tire manufacturers are capable of competing with China, not only in India, but in the global market. One is a quality perception point of view. Indian tires are viewed as good quality tires. And where we seem to be having some issues in terms of Chinese tires coming into India is predominantly because of inverted duty structure that tire industry suffers in India. Natural rubber, synthetic rubbers, carbon black, they are all imported at a much higher rate of duty. Rubber is at 27.5% natural rubber, synthetic rubber also 15%. In some cases, even anti-dumping duty is there. Whereas Chinese tires either from China or from Southeast Asia with free trade agreement was coming at 5 and 6%, that kind of a range. So therefore, government introduced anti-dumping duty on import of tires from China. Okay, but however, it is not applicable for Southeast Asia. Only category of tires which comes more in India and sometimes is commercial tires called as truck and bus radial tires. With the introduction of anti-dumping duty, I think it is regulated. It's not moving up or moving down. So in that current range, I don't see a big threat.
Okay. With that, Mr. Subbiah, all the good luck for the coming 4 quarters. Let's hope for a fantastic set of numbers from CEAT Limited. The stock, by the way, ladies and gentlemen, over the last 3 weeks has appreciated dramatically from a low of about 23.30. We are now somewhere in the vicinity of 33.30. So that's a nice 45-46% appreciation in the stock ahead of the earnings. What will unfold from now on, only time will tell. But here's wishing you all the best, Mr. Subbiah, for a great quarterly set of numbers from now on. Thank you for your time, sir.
Thank you. Wonderful talking to you.
That, ladies and gentlemen, was Mr. Kumar Subbiah, CFO at CEAT Limited. Please continue watching Business Today television. There's a lot that's happening on the other side of this break.
So it's time for our Tech Help section with Sana. So